Hey, what's up, guys? My name is Haya Fayaz, and this video is very impromptu. I'm not getting any question in advance, not copy pasting anything right here. I'm just making up a question right now and solving it for you guys because it's pretty much I'm covering a lesser accounting topic, a lesser accounting question. How would a lessor account for leases in his books of accounts? So for that purpose, I will just make up the question on my own right now because it's pretty much similar to lease. Only thing is it has to be treated like an asset. But just to clear out all the confusion, I'll solve the question and help you guys figure this thing out. So there's this company, any random company, a bank trying to lease out some aeroplane to an airline company, right? And the rentals under the lease contract, rentals are in advance. Suppose let's take the harder part, the advance part, right? And it's like 6,000 per annum. 6,000 per annum. Let's start with simple figures. Then the rate implicit is 4%, implicit rate of lease at which the bank is offering the lease to the airlines company. And this is the rental income, this is the lease. This will go on for 5 years. Contract period is 5 years, right? So now, like as I said, it's same as leases, how lessee account in his books. So I will firstly hunt for the words like lease liability and right of use, but that's not the case here. But I will find out what is the gross receivable for sure. There are terms like gross receivable and net receivable used. So for like how lessee would account for a lease liability, similarly I would account for a gross receivable. It will be basically the present value of all the payments that I'm about to receive, discounted to today's period, plus the residual value, at the end of the lease. So I should include a residual value too, just to reduce any confusion, delete any confusion. So it would be like 500 probably. Yeah, it's just 500. So 0, 1, 2, 3, 4. Okay, so 5, 1, 2, 3, 4, 5. Yeah, it completes the 5-year contract, right? Yeah, so for accommodating our residual value, since it will be at the end of our lease contract ends within these 4 years, 4-year period, actually including 0, it will be 5. And then I include 5 for the end of the lease, right? The last year. Like we should take as if basically it's the start of each year. It's the start of year 1, start of year 2, start of year 3, start of year 4, start of year 5. Like, each of these figures represent the start of the year. So remember that. And this is going to be 500 here, while all these values start with 6,000, 6,000, 6,000, 6,000, and 6,000. And finally, it is going to be sold for 500. Now I want to discount all these, so I'll use the implicit rate of 4%. 4% present value at 4%. So is equal to 1 by 1.04 power. No, there's no power. What the hell am I doing? It's 0. It's at time 0. So the present value, let me just write it as discount factor column. The discount factor is going to be 1. Of course, like at time 0, the value is going to be equal to this only, right? And then 1 by 1.04, the whole power 1. Yes. That's how I'm going to simplify my calculations and make use of spreadsheets, right? Yeah, smart. Yeah, I know. Whatever. Just kidding. This into this and then bring it down. Sum of all these values, right? All of these present values, and that's going to give me the gross investment. As simple as that. So at time 5, this is my value. I'm bringing it back to time 0 by using a discount factor of 4% and exponent using the exponent of 5, like the power of 5, and reducing it back to back as if it was today. It's as simple as that. This is basic calculation. So, and this one is like 1 by 1.04 power 4. I want to reduce this figure back, the cash flow at time 4 to time 0. Similarly at time 3 to time 0. So the power would be 3, then 2, then 1. All of this respectively goes on. And I end up getting a gross investment of 28190. Right? So then my scenario, as I said before, the terminology of net investment is used. Net investment is where you are doing the same amortization table calculation that you do for that a lessee does in his accounts, right? So it will start with opening, but in my case, since it's in advance, so income, no, we call it finance receipt paid, then implicit rate finance income, that means at 4%. What am I getting? Let me just extend this column. This is like that, and finally this comes to balance brought down at the end of the year, and this should be the year 1. So year 1 opening is equal to this, finance receipt paid is equal to minus 6,000, then implicit rate of finance income 4% of these two things, add this plus this, right? 4% of that, and the sum of all of this will give me the finance income, sorry, the balance brought down. Then I will bring down this balance to the next year, 230. Why am I doing this? Like that. Again, minus 6,000. Now I will account for my non-current asset like this, same like how we do for liabilities, non-current asset. So it will simply be this plus this, right? And my current asset, that means a receivable that I will receive in this year, that I am obliged to receive this year, actually, like I'm going to receive it this year, would be simply put this minus this, and I coincidentally end up getting 6,000. Okay, that's good.